A lot of people are afraid that there's builders coming in and there's so much more building happening and we're going to be stuck where we were 10 years ago or 15 years ago with overbuilding. I can assure you that right now that is not a risk you need to worry about. It's really the undersupply that is the issue. If you look back to 2005, look at how much overbuilding was happening. 1.6 over 1.6 million new homes. And in 2004, I mean, record high in new home construction. And then the market collapsed and there was foreclosures everywhere and builders weren't, they lost their land and they lost everything and nobody was building. I mean, there were some, but really hit some all-time lows. And look at it's taken so long to get back up. We're not even halfway back to where we were, and yet we still have population growth. So where are these people going to live? And that is the story. That's the story that we're not going to see equilibrium. It's predicted unless there's some big change in immigration or something, or lots of babies being born, but we're actually seeing the opposite, less babies being born. So where are we going to see enough, the equilibrium? And they're saying 2024, basically, where supply would be in balance with demand. But until then, there appears to be far more demand for housing than there is supply. But it's not everywhere. I mean, there's certainly areas that have a lot of supply and where we're seeing prices go down, and that's some of the headline news you'll see. It's just in certain cities where it's kind of obvious. But what are the clues as to where you're going to see more demand for housing than there is housing is where there's job growth. Because whenever there's job growth, that's where people go and they need a place to live. So again, we know that it's been an uneven expansion. This is a John Burns real estate consulting slide. And we can see that some, Austin, Nashville, Dallas, San Antonio, Orlando, Denver, Charlotte, Salt Lake, Houston, Seattle, these are all areas that have had tremendous job growth. Tremendous job growth. You look at the bottom, and Los Angeles is down there, Orange County, Sacramento. I mean, Philadelphia, not as much. It's growing. It's just slower. It's just slower. So you're going to find better deals here because it's a slower growth kind of place. It's in these areas, prices are going up faster. And here it's kind of average. So a lot of people say, well, gosh, if Austin's having the greatest job growth, why don't you have a team there at Real Wealth Network? The problem is we've loved Austin for 15 years. We've been looking at that market, but we just can't seem to get the kind of cash flow from Austin that we can get in Dallas and Houston. So even though Austin's just booming, I'd rather have cash flow in a booming market. So Houston and Dallas are more, I don't know, more interesting to us. And then Orlando, again, another great market where you can still make the numbers work. Denver prices have gotten a little expensive. It's hard to cash flow. San Antonio, even though there's a lot of jobs here, it seems like they're like a little bit lower paying jobs, and it's, again, harder to make the cash flow work because people just can't afford for rents to go up too much. At least that's my understanding of it. All right, this slide I've shown a bunch, but it's worth seeing again. This is John Burns Real Estate Consulting. They consult builders on where to build and where to not build and where the demographics are. John Burns has consulted our team on our Tampa property where we acquired 4,200 lots about 8 years ago, 7 or 8, maybe, yeah, I don't know, somewhere around that, 7 years ago, and they've been helping us with that process, and we're real lucky because it just so happens to be right where the massive growth is headed. We didn't know that back then. We just knew we got a great deal on the land, 10 cents on the dollar back in 2012. Anyway, John Burns does a tremendous amount of work on demographics, and this slide is interesting. 5 million more homeowners expected by the year 2025, 7 million more renters, and most headed to the south. So whether you're building homes for homeowners or for renters, there's just going to be lots and lots of demand in the south. A lot of people ask me about Boise, Seattle, Portland, and I look at this slide and I say, well, sure, those areas are great and they're cheaper than California and they're nice places to live. You're just not going to see the cash flow and maybe not necessarily the price growth or rent growth that we might see elsewhere. Plus, cash flow, forget about it. So still good markets, just my opinion, I'd probably still look at the Southeast. I showed this slide because I think it's really important to understand that there's going to be renters, there's going to be a lot of renters. And now, will they live in apartments or single family homes? And that is the big question. If you're buying apartments, how high can you push those rents? Because so many people are basing their entire pro forma on the assumption that they're going to be able to raise rents. But can they? Because remember, there's a ceiling. There's a ceiling to how much people can afford. Now, this study, again, was done by John Burns, and it's showing that in a lot of markets, multifamily has been overvalued. And look at that, San Francisco East Bay at the top of the list of overvalued. In Indianapolis, Jacksonville, considered fairly valued. So just be careful with apartments and making assumptions that rents will continue to climb. Again, no matter how nice the place is or how pretty you fix it up or how well it's located, if you can't raise rents just simply because people can't afford to pay it, then you're stuck lowering rents or keeping them the same, and the numbers maybe don't work out as well that way. So just be aware. Just be aware. I was at a single family rental conference from IMN with some of the Wall Street's biggest hedge funds in single family. They had, they've been in multifamily for decades, but single family on Wall Street is a whole new thing. These funds that are buying single family homes. And so these, big hot shots were on stage basically explaining why. Why would they go through the effort of owning a bunch of single family when they can own apartments like they have for so long? And what they all had in common is that they said they were getting higher returns on the single family. So remember, you can get financing on a portfolio of single family funds. A lot of people have said in the past, what's great about apartments is that you get one loan on a bunch of units under one roof. Well, in single family, you can get that one loan still. I mean, there's so many lenders who would be so happy to lend to you on your portfolio of homes. It's not going to be a 30-year fixed rate, but it's going to be a pretty darn good rate. And so these fund managers from Wall Street were saying they're getting better returns on their single family. Now, why would that be? Again, people are talking about millennials, but remember, the oldest millennials are turning 40. Like, they're old now. I mean, I can say that because I'm old, but but they're not. These aren't little kids anymore. There are some that are still in their 20s, but we're talking about a generation that, they've got kids. They probably want those kids to play on a lawn and have a playground and so forth, and not necessarily live in an apartment, especially if you have dogs too. So we're seeing more and more demand for the single family, especially as this wave of millennials that are still in their 20s starts to form the families and want that. Okay, so looks like that is my last slide. As you know, I've got these two podcasts, The Real Wealth Show, where I interview people who will share their stories and kind of break it down, make it a little bit easier to understand, and the real estate news, where I try to bring the headline news and understand it and break it down and make sure we're all staying on top of the changes. Because, I leave this update with, hey, we didn't have a recession. I didn't think we'd have one. I don't think we're going to have one in 2020 either. Not because it shouldn't happen, but because it just won't. We have forces at play that don't want that to happen, and there are ways to stimulate the economy and avoid that recession at all costs. And that's what we're going to see, at least until the election. What does it mean after that? There could be a recession. A lot of people are predicting the end of 2021. There could be, but what we're seeing is it may not be in the real estate market. So even if there's a hit on Wall Street and there's job losses and so forth, there's still so much pent up demand for housing that, it just probably won't affect our market that much. And even if it did, but you're buying rental homes, you got to know there's going to be rental demand for at least halfway into the 20s. By 2025, there's still going to be enormous rental demand because, like I said earlier, and this will be in my 2020 predictions, so I'm giving some of it away. But you've got so many people who've taken on massive debt. We love to spend money. It's easy to walk in and buy a new car, just get the credit for it, walk in and sign up for your favorite university and get it $60,000 per year loan on that for something that may or may not ever bring you a job in the future. So people are walking around with a whole lot of debt. And unfortunately, or fortunately, the lending environment is very, very strict. So one of the first things they look at is your debt to income ratio. So even if you make money, but you have too much debt, you're not going to get that loan and you're going to be forced to rent. And that's what we're seeing. So even with job growth, wage growth, and population growth, we're people unfortunately are buying in reverse and buying depreciating assets like cars and and things and vacations instead of assets like housing. So when you flip that around again, it's like I said, there's opportunities in everything. If you're a real estate agent, this is your opportunity to truly educate people on how to build wealth and the tax benefits and all the benefits of instead of going and getting that new car and that car loan that's going to prevent you from being able to buy a house, that maybe the first thing you should be looking at is how to qualify for a property. And if you are living in a high priced market and you'll never have enough money to buy that high priced property with that huge down payment, you could probably, I think anyone, probably my 20-year-old daughter still in college with a side job, she could probably qualify for at entry level rental property because it's really only $12,000 down, and you get to count the rental income or a portion of it in your pro forma and when the lender's looking at you. So educate yourself, educate others. This is an opportunity to buy rental property, and builders simply can't build affordable housing, but we can. We can go in and buy older homes and make them newish, renovate them and have people feel like they're living in a new home. Or we can actually build, as you know, we syndicate and raise money and pool funds and buy land and build homes that are on the affordable range. Our Carson City project, we're building new homes for the kind of average home price of the area. So that's phenomenal. Fred is just really, he's never done that. He's always built super high-end luxury homes, and he's realizing that's not where it's at today. It's in the affordable. Even in Discovery Ridge, our home development in Park City, we're keeping it super affordable, like below the median home price there, and 30% of it is super, super affordable because it was required. It's like 300, 400,000, but those are already sold. But then the newer homes are starting at 700,000, which is considered super cheap in Park City. And we know that they're going to fly off the shelf for that reason. Plus, it's exactly bordering this new super cool training center in Park City. So I'll be doing a blog on that. It's pretty cool. All right, so I think I have some time for questions. Let's see. Hi. I recently learned about RWN through Ben. I'd like to explore introducing RWN to our clients. Cool. Yes, let's do it. Will this webinar be on replay? Yes, we always upload them usually same day on our site. Do we want to own single family homes where apartment rents are high or low? See, the thing is, regardless, I mean, there would have to be a huge divide, but if you've got a family and children and dogs, you're going to look for that single family home, and you just might move out a little further to have that. And that's what we're starting to see again. It's nothing new. People are going to move into the suburbs, but the suburbs are getting more cool. There's developers are making little downtowns in the suburbs, so they're more interesting places to live. Like Walnut Creek, for example. I was on Southwest yesterday, and there was in the Southwest magazine, there was an article for Walnut Creek, California, where I basically raised my kids. Like Walnut Creek, that used to be just a sleepy town, but now it's a destination. It's a cool place. There's a lot to do. Great restaurants. It's beautiful. Great shopping. And you just jump on BART and you're in downtown San Francisco, but you get better weather in Walnut Creek. So we're seeing that as more of a trend, that the suburbs are becoming more cool, and that's attracting the millennials who kind of liked the downtown living, but not when they've got family, and so they're going to move out to the better schools and where they can have grass in their, have a backyard, and it's just the same old, same old. But we're seeing this massive wave of millennials. So, apartments are great to own if the numbers work. why wouldn't you? You know, apartments are great. It's just harder and harder to find any apartment where the numbers actually work based on real numbers versus projections and hope that you can keep raising rents because you don't know if you can. You don't know for sure. Whereas with a single family home, it's just a little bit different, not as dependent. The loan is not dependent on you being able to raise your rents. So it's just up to you. It's what you're comfortable with. I happen to be comfortable with single family, but if I saw an amazing apartment deal, believe me, I would want to know about it. So bring it to us if you got one. Thanks for the update. You are welcome. What do you think about the trend of building single family homes to rent? How long will that cash flow? I love the idea of building whole communities as rentals, sort of horizontal apartments. The only way I think it can work is if the entire thing is under one management company, just like an apartment. You've got a manager at that apartment with 100, 200, 300 units, whatever it is, and that manager manages it. So you don't have 300 units in that apartment building, all with people with different property managers. Can you imagine that? An apartment building with 300 units and 300 property managers? It would be a nightmare. And I've seen people try to do that. And you don't want to do that. So if you're going to have a whole subdivision where the entire thing is rentals, it better be all under one management and controlled that way. So ideally in a fund owned by a manager that treats it like an apartment and keeps it up that way. If you've got too many individuals in one subdivision who all own properties individually and have their own property managers, and one of those people runs into financial trouble and they cannot, make it work, and they got to sell at a discount, or they got to, rent it at a discount, and they bring in the wrong person, oh boy, and they mismanage, it brings down the whole community. So even if you're talking to one of the teams in our network and they suggest something like this, because we can't control everything they do, we can only help educate you to make the right decisions. But if you run into anybody, including any of the property teams in our network, who suggest that you buy in a subdivision that's all rentals, or that you buy a condo in or a townhome in an all rental neighborhood, be very, very cautious, because it can get dangerous if it's all rentals with different property management. If it's all under one management and that's part of the HOA and it's part of the deal, then it could work. So we want to do it. We are looking at it, and I think it could be brilliant, because when the time is right, you can just sell off a house at a time to a retail customer, to a homeowner. Um, it could work out very, very well, and we're definitely looking at it. I can tell you that at the IMN Single Family Rental Conference, that was the talk that, that's what these hedge funds are now looking at doing. I came in a little late on the webinar. My business model is virtual wholesaling, contracts to landlords. What markets would you recommend? Virtual wholesaling, contracts to landlords. I don't know. I mean, I would think that you would want to work with people who really understand that. A lot of our members at Real Wealth Network don't have teams. Let's say you had a really great wholesale deal in, I don't know, Jacksonville, but you don't have a team there to fix up the property or even know if it's in a good area. It could be challenging. So personally, I would send those to our property teams, and then they can make sure they're fixed up properly and they're in the right parts of town, and that they can then sell them to our investors as an already fixed up property that that has kind of their stamp of approval. That's what I would do. All right. It seems Nashville's booming. What about Memphis? Nashville is booming, and man, I wish we'd gotten in there early. We were really heavily involved in Nashville in 2006, 2005. We were, oh my gosh, we were buying condos downtown for $200,000, and our members were they were buying great stuff. Now the housing market collapsed, and some people just kind of sold their condos or their townhomes at a low price, but if they had held them, oh my gosh, they're downtown, they would have probably quadrupled their money. So we love Nashville just as a place. It's awesome. It's such a fun place to visit. It's hard to find cash flow right now, and some people are saying it's one of the more overvalued markets in the country. So just be cautious there, but I'm sure you can still find good deals if you know how to look. Memphis has been a hot investor market for a long time. There's a couple of really good teams there, but it's just more expensive. Prices have gone up, and there's kind of a lot of crime in parts of Memphis. A lot of investors there, so you just got to be cautious and have a really good team there, because if you buy in the wrong neighborhood in Memphis, you will pay for it. It will not be good. But if you buy in the right part of town, it could be great.